Welcome to Classic Value Investors and Microcap Explosions. This is Mariusz Konieczny, and today with me I have Kuppy, Harris Kupperman. Kuppy, thanks a lot for doing this again.
Hey, happy to come on anytime.
It's been a while. Lots of things have changed, so I just wanted to kind of, um, catch up, and let's talk about three things. Let's talk about a little bit of tankers. I know you, and then your new idea, Sanjo, and I can't believe I'm saying this, Bitcoin, but we'll get to it. What's going on with tankers? Are you still in them? You give up on them, moved on to something else? Just give us an update on that.
Well, I'm definitely still in tankers. I got into tankers originally with a multi-year thesis that two things would happen. One, the order book would stay pretty skinny, which it has, and that two, with the oldest fleet in almost 20 years, there'd be some scrapping, especially with new environmental regulations that are kind of speeding it all up. And quite honestly, it's played out better than I expected in many ways. The fleet stayed skinny, even though we had a huge spike in rates. We've seen almost no ordering. Actually, we're comping down against the prior year, which is really quite great. Even better, 2020 is going to be the best year for tanker earnings in over a decade. 2019 wasn't bad either. It's actually playing out better than I expected. People can look at the share price and be bitter and annoyed, but I don't control the share price. If you get the macro thesis right, eventually you get paid in my book. And, we had two chances to get paid where you had a double on the screen. And, I took a little bit off each time they popped, but clearly not enough. But, I'm not here to really day trade these things. I have a long-term view and I'm going to stick with it. My entry is, pretty great in terms of price. And, I'm frustrated to have round tripped them twice, but that's life. The great thing about being in a sector trade like tankers is that they don't all move at the same time, and there's been multiple opportunities to trade between the different tanker names, and I've done quite a lot of that.
So what kind of movements or switches between the tankers did you make?
Well, let's just walk through the history of it, I guess. I started off with a basket, heavily weighted towards clean product. I thought IMO 2020 would really push demand for clean product, which it did. Tanker rates spiked, but Scorpio got to a premium to net asset value, and I took some off in January of this year. Partly I played the position with January call options. I didn't plan to take delivery, so I booked those. But when I saw Robert Bugbee booking his call options, I figured the insiders are smarter than me, and I booked about a quarter of my common as well. So I booked some at a premium to NAV. I wish I booked more, but I booked them in the high 30s. About 2-3 weeks later, we had the first rumblings of COVID. The tanker stocks collapsed. I added back some of my Scorpio, but this time, given the fact that rates had dropped, I was much more focused on the guys with better balance sheets. If in a bull market you want to buy the guys with the stretched balance sheets, they have the most upside. But and in a pullback, you kind of want to have the safety too. So I reallocated more towards Euronav and DHT. When the Saudis sent their Saudi Armada our way and rates went crazy, I put on a lot more TK. I bought mine about 12, $13. I had an initial position from 8, but I like tripled it and made TK actually my largest. And the TK had huge earnings in the first 6 months of this year, Q4 last year. They sold a bunch of vessels. They locked in a third of their fleet. I'm very happy I own so much TK. When tanker stocks spiked in March and April, I took a little bit off again. Not so much because I thought I had the thesis wrong, but when you put someone on, and I run a fund, so we have position limits. So when you put it on its position limit at entry and it doubles, you got to take some off. It's just risk management, and it goes backwards looking when you go, thank God I took some off. But yeah, I took some off because the position doubled. I took some off in common. I sold a lot of calls, which lowered my basis. Then when the tanker stocks started pulling back, I just kept selling calls the whole way because I had this view that you'd probably have decent earnings for a while, but you could sell out of the money calls and get paid a few percent a month, and you'd be stupid not to. And so I stayed long and kept selling calls, which lowered my basis quite a lot. About, I don't know, when Scorpio came out their Q2 guidance and they missed by by a mile. I booked that all immediately. You don't need an over leveraged tanker play that's missing earnings. That's kind of a disaster. And I swapped it for Dorian because VLGC rates are doing phenomenal right now. Dorian's about 40% of NAV. I was buying mine at about 35% of NAV, and they're just printing money. So I swapped it for Dorian. Booked a little bit of my Euronav, booked some more of it. When TK collapsed, I booked the rest of my Euronav because Euronav was 9 and change, high nines, 975, and TK was 12, and you just basically have a bunch of things bouncing around. And you cycle between the one that's down the most. I mean, you can build a simple spreadsheet to track this stuff. It's not rocket science, and I've been trading between the names, so I ended up now with a whole lot of TK, a whole lot of Dorian, and when rates start recovering, I'm probably going to reallocate to some of the other names as well. But for right now, the TK has one of the best balance sheets in the tanker sector. They've termed out a third of their fleet, so even when rates aren't so good right now, they're doing just fine. And I'm waiting for the next inflection to grab another chunk of stocks.
Now, outside of the balance sheet, if you are in TK, does this mean that you have a view that more positive view on the crude tankers versus the product tankers at this point?
Um, I think I have just an agnostic view. It's a big basket to me. Product tankers really should have done better. IMO 2020 really, should have given them more strength. For whatever reason, product tankers just haven't performed well, and I don't really know what that is. And so I'm just, I guess, a little more optimistic about the crude tankers. I mean, when you look at what's happening in the world right now, the U.S. was 14 million barrels, this time last year, and I don't know where we're going to be, but let's call it 9 or 10 next year. And so you got 4 or 5 million barrels we have to import. Canada's down a little, and that's rail and that's also pipeline to us. So let's say we got to bring in 5 million net barrels. That's got to come on tankers. Where else is it going to come from? And you kind of look at a map, and Venezuela is a mess. We're not friends with them. Mexico, exports are down. You get a little bit of uptick in Guyana, maybe a little bit in Brazil. West Africa is kind of a mess. Libya has no government. North Sea had a spike, but it's going to trail off again. You start looking around the map, and where do you find 5 million barrels? And that's all coming from the Middle East. And if it is coming from the Middle East, those are some pretty long hauls to United States, and this is going to be at a time where I think the U.S., just because of differentials, is probably still going to be exporting light sweet, and we're going to be importing other crude grades, and there's just going to be a lot of movement. And I can make a very strong case for why you'd want to be in the dirties, and for whatever reason, it's harder to make the case for the clean beyond the fact that a good chunk of the fleet's old. I mean, in the end, you need demand growth too, and I don't know if you can have that demand growth in the same way. I mean, it doesn't mean I'm against cleans, and if rates start moving up, I'm definitely going to play it, but I'm a bit more optimistic on the dirty side.
Yeah, I'm curious. How do you now view the COVID situation, and how it relates to the tankers?
Well, I mean, when you think of what happened, we had a super spike in March, April, because there was a contango, and then you had massive storage demand. Okay, and I queued in on that very early, which is why I was able to catch the inflection and make a good chunk of money. Now the problem is that you have the hangover from that, so you have this glut of oil, and we're working that glut down slowly, but not fast enough, and you have a very shallow contango, which isn't really paying anyone to store oil. And what you really need is to work down this glut of oil so that oil starts moving around again. And, in my mind, COVID's kind of done. It's a bad cold. A few of us, will be, pretty badly impacted, but the vast majority of people are going to be just fine. And, governments really should be just saying, you guys are all going to get it because they all are, and going on with life, and taking extra precautions for people that are most at risk, which just tends to be older people. But the vast majority of people can go on with their lives, and I really do think that that's the end result. And demand for oil will bounce back, and supply is down still, and actually supply is probably going to keep declining. Especially if OPEC has some restraint, and so we'll work down this inventory over time. And I don't know if this is a Q1 or a Q2 thing, but eventually demand for oil transport will uptick, and that's going to be very good for my tankers. And it's a reason to stay long. If my tankers were trading at a premium to NAV right now, I'd say, I can go cycle into something else, and I'll come back. But with these things trading at a third of NAV, I'm not going to sell out at a third of NAV and hope to come back because the market's forward looking. These should start trading up a few months before you see the uptick in export demand
Yeah.
or
Okay.
import demand.
Okay, perfect. All right. So thanks for the update on the tankers. Now let's move on to St. Joe. I know this is a new idea that you recently tweeted about, but I'm gonna make a guess that to you it's not a new idea because I've heard about this company because of Bruce Berkowitz and for years, and there were arguments back and forth. So then when I saw you talk about it, it just kind of brought the memories. So having said that, I know it's not a new idea, but like, why now? What what's different now than a few years ago?
So, I mean, just for your listeners, I mean, St. Joe owns 175,000 acres in the Florida Panhandle, and for decades, it was always a story that one day they'll develop it and the land will be worth quite a lot of money. I don't think anyone's ever disputed that the land is worth, somewhere north of $100 a share. And I don't think you could be any more precise than saying it's worth more than $100 a share. And that was the case 5 years ago also. But always the question was, how do I get paid on this? Because unless Bruce wanted to sell out, you weren't getting paid. What's changed really is demographics. I mean, Florida has always had net inflow, but that inflow of population has been accelerating lately. Partly you have people fleeing COVID, and we've been a lot less draconian here. Our governor's done a great job in saying, this is kind of a hoax. But you've also had people fleeing high state tax. But the real thing is when COVID made work from home viable, people in states or cities that were very expensive said, why do I have to be in this place? Why, do I have to pay so much in rent? Why do I have to be, around, the BLM riots and all the stupidity? Why can't I be somewhere that's absolutely beautiful on the beach? And, you've just seen a lot more rapid inflows into Bay and Walton County, which are the two counties that St. Joe has the most of its land. I mean, they're actually two of the fastest growing counties in the United States, admittedly from a low base. And it's just for people who've never been there. I've taken a lot of friends down to the Panhandle, and they always expect to see a bunch of trailer parks. And instead they always amaze, even though I warn them in advance that it's $5 and $10 million homes. But when they see it, they kind of understand the appeal. You get to escape from all the stupidity and problems of a city. You're just going to be basically hanging out with other one percenters, and it doesn't cost a one percenter lifestyle all the time. It's not quite like going to the Hamptons. And I'm from Long Island. I remember going there as a kid in the 1980s, and it was just potato fields. And those potato fields are now horse farms and beautiful estates. And the same thing's going to happen to St. Joe. And those acres are going to be priceless. And I think given what's happening, where everything from lot sales to commercial leasing revenue to hospitality revenue to club revenue. These things are all growing at ridiculously high rates, close to 30 to 50% a year right now. And so you're coming into what is really a rapid growth stock, and you're coming in at a value multiple. I think you're trading at less than 10 times, or at least from my cost basis, less than 10 times 2022 AFFO, and you're probably coming in at a mid-single digit AFFO multiple on say 2024, 2025, and where else in this world can you come in at a single digit AFFO multiple that's growing, call it 50% a year because you're getting some leverage on OpEx, and you get $100 a share of land tossed in for free. I mean, it's finally hit that critical mass that it matters.
That's interesting. Okay, so I was going to ask you how you value this thing, and you just answered it that it's cheap based on income or FFO, and but you also get a margin of safety through the land ownership.
Right. I mean, it's really imprecise how to value it. In the end, land is an asset that has a very wide bid-ask spread, and so you can't go there and build a giant spreadsheet and say, I think this acre is worth this and that acre is worth that, because you're not going to come with any sort of precision. I mean, you have to go there and look at what they have and say there's absolutely no way on this earth that these shares trading at 26 are fairly valued. And it's not that you think it's worth 30 and it's trading at 26. It's that you're low estimate is 100 and it could be 200. And when you start having that sort of certainty about what it's all worth, you can then look at it and say, there's no way I get hurt here. I mean, minus, basis risk. It could trade down to 19 where it was a few months ago. But, outside of that, if you're willing to hold it for a while, and, I intend to hold this a very long time, I just don't think you get hurt. And it's really just a question of how well management executes in terms of how much money you make. And I guess the final thing I'd say is that every time there's a riot in some city, and every time they burn down something or shoot some innocent guy having lunch, I think more people that have the ability to flee the chaos are going to want to go somewhere safe. And you know, I tend to think that you're going to start seeing St. Joe spike 10-20% every time that some of that stupidity happens.
Well, you're
It's
definitely
just it's a way to play urban violence and urban stupidity in my mind.
well, you're definitely seeing people from big cities, whether it's New York. I have a friend that just moved from New York to Miami, but then you probably have people in Miami that are tired of Miami and are moving to areas where St. Joe operates. So we're definitely seeing that because of COVID. But with that being said, like if it's widely known that the land is worth significantly more than the stock, so what's like the short thesis? Because I know not everybody's buying it.
So honestly, I'm struggling to find short sellers. I've reached out to some of the more vocal ones in the past, and they all say they're out of their positions. There's still more than 6 million shares short, so clearly someone sees flaws with my argument. I really do think the short thesis was that this is all swampland that's going nowhere fast. Management will sell off the best acres, and then there's a fixed opex of running the business, and they'll just burn through all the capital. And for a very long time, the company after land sales was losing money. The difference now is that they're actually going to make money on the business where the recurring revenue is going to be in excess of OPEX. And this is at a time when they have over 30 projects on the go that will increase recurring revenue. If you just look at all the announcement they have what, 3 hotels and 1,000 units of multifam, and you got all sorts of other littler assets that are on the go too. And you can actually look forward to where they'll be a year and 2 years from today and say there's a lot of cash flow here. And now for the first time, in forever, this thing is actually sustainably cash flow positive, and that cash will then be reinvested in either new projects or more buybacks. The company's been buying back shares over time, but you don't even need the land sales. And then when you look at the lot sales, look, they're going to sell maybe 1,000 units next year, maybe 1,200 units, and in total they have more than 200,000 units of developable land that's permitted. So I mean, you have a 200-year runway there. So, I mean, you could look at the lot sales and say, it's the farmer selling his land for seed corn. It's not sustainable. Or you can look at it and say this is going to go on for 200 more years, and that's way past, the end point of anyone's DCF. And in that case, it is sustainable. And you can make the argument either way, but in the end, if you're going to take in 50 to 100 million a year of sustainable cash flow through lot sales, that's a lot of cash.
And talking about the recurring revenue that you mentioned, so when what's the recurring revenue comes from? Does it come from like apartments that they develop and they keep them?
So they have a number of divisions. They have a number of hotels that are, when the rest of the world hotels are comping massive negative. St. Joe hotels actually are going to comp positive this year, despite the fact that they were closed for 2 months, which just shows you how much demand there is from people who want to escape large cities and go to the beach. They own some strip malls that are doing very well with almost no vacancy. They own some multifam. They own, your gas stations and box stores. They have a clubs division, which is golf clubs and marinas, and a beach club. They have a lot of divisions that are a lot of assets that are sustainable cash flow. And then you have this massive pipeline of new stuff coming.
Okay, all right, perfect. So thank you for that, and let's move on to our third topic. I
I
mean,
mean, I guess a final note. I
yeah.
mean, this is my largest position. I feel like there's a lot of stocks like tankers. You really got to spend a lot of time on. You got to go, every day. What's happening today? What's going to change my thesis? What's going to kill my thesis? St. Joe is just so great in that you can put it on as big as you can, and you don't have to think about it very well. I mean, you don't have to think about it very long once you know what the assets are. And to me, I've always been something of a guy who's looked at inflation, been scared of inflation. I've owned a lot of gold from time to time, and I've basically swapped out my gold for St. Joe. In my mind, this is basically gold that has a pretty high return on capital as well, and they're just reinvesting the money in more gold. Anyone who's into gold mining, anyone who's into gold, anyone who's running a pension fund, I just don't know why you'd ever own those sort of assets when you could just own this. And this trades at a sizable discount to NAV, and you can make the case that if NAV is 100, let's just throw a number out there, maybe this ought to trade at 70. But if you make the case that they're going to keep growing for many years into the future, I mean, why shouldn't this trade at a premium to NAV? And I just don't see why. I mean, it's kind of like a box checker for me, as it's my largest position, and I feel very good about it.
It seems to me that the hardest thing on this will be to sit on your ass and do nothing and not get bored.
Yes, that's why I'm doing so much event-driven trading, because this is fully marginable, which lets you use a little bit of the borrowability, or margin capacity, however you want to think about it, and do things that are very high return on capital. But yeah, I own it. It's literally not even on my screen. I just know I own it, and I own a lot of it.
Yeah, okay. And so let's move on to the next topic. I mean, why are we talking a bit about Bitcoin?
Why wouldn't we talk about Bitcoin?
I can't believe I'm asking you because I don't even pay attention to Bitcoin. So tell me like because I think in the past you weren't a fan of it either. So obviously something must have changed your mind. I mean,
Well,
from my point of view, you know why I wouldn't own it. I can't value it, and so that's about it for me. But I do want to know like why people like you actually like it now.
so I've not been opposed to Bitcoin. I had some of my Bitcoin stolen from Bitfinex, and ever liquidated them all at 650, which is kind of frustrating because I had a lot of them. But I've always been positively possessed towards Bitcoin. In the end, Bitcoin is people call it a distributed ledger. I think of it as a distributed Ponzi scheme. Bitcoin is fundamentally worthless, but it's worthless in the same way that gold's worthless. Gold only has value because people are willing to accept it. This is the various rules of what makes up a currency, and you could kind of apply the same thing to Bitcoin. Gold only has gold's emotional. It has a value because it's traded. It's a very liquid market, and people emotionally assign a value to it based on whatever events they're seeing. And Bitcoin's kind of the same. It doesn't produce any cash flow. The easiest way to value something like this is much like gold. Look at the all-in sustaining cost of producing it, and then apply some small margin over the full cycle. But for me, I think of Bitcoin really as a Ponzi scheme. It's a distributed Ponzi scheme. I mean, go on Twitter right now. You have some of the best and most respected and most well-known minds in finance, and they're all whoring the thing out like madmen. And you have everything from kids that own one coin or 1/10 of a coin, or computer nerds, and you have people in other countries, but everyone's pushing the positive narrative, and it's catchy. But what really got me back into Bitcoin is this vehicle called the Grayscale Bitcoin Trust. The ticker is GBTC. They are a closed-end vehicle where they do a continuous offering, and so every day they issue more shares and buy more Bitcoin. But the Bitcoin never leave the trust once they're in the trust. So as long as the trust trades at a premium to net asset value, which it has pretty much since inception, they are going to be issuing more shares and buying more Bitcoin. And so you have this thing where if you think of Bitcoin, the true functional float, it's somewhere between 6 and 8 million coins. You have a good chunk that are owned by those whales that are never going to sell, or at least they haven't been selling. You have a good chunk that's been lost to humanity because people forgot how to get into their wallets. You're really looking at 6 to 8 million coins, and so think of it like a small cap stock with a small float. As that float gets consolidated, the number of shares outstanding are fewer, and means it could be manipulated easier. And so that's what's happening with Bitcoin. You have Grayscale, which every day goes and issues more shares. They've been buying just massive amounts of this stuff. You have Square, and you have MicroStrategy. They're buying it. You have hedge funds that eventually will be sellers. They buy at one price and sell at a different price. But for right now, at least, they're restricting the float. You have everyone restricting the float, and then you just have to look at a chart, and Bitcoin trades with charts, much like gold trades with charts. If this thing gets above 12,000, it's just going to keep going. And there's a lot of FOMO out there, and I think that FOMO will be infectious in a pretty illiquid, thin market. So I'm just looking at this and saying this is the ultimate Ponzi scheme. And if you identify a Ponzi scheme that is liquid, this isn't like Madoff, where you put your money in, you can't ever get it back. I mean, this is a liquid Ponzi scheme. You identify an entry price, you take very little risk, and you ride the Ponzi scheme until it bursts. And I have an exit in mind, and I'm going to keep raising my exit price, and eventually I get taken out of it. But for now, when a Ponzi scheme is inflating, you want to be long.
Interesting. Okay. Anything else you do? Any event-driven events that you're looking at besides these three things we discussed?
Yeah, I just want to chat about event-driven. My entire life, I've followed a number of event-driven strategies, and these things. Each individual strategy is probably about 30. I'm pretty actively following. They kind of go into vogue and out, and there'll be a lot of returns, and then they'll kind of fade off. You don't really make any money for a couple quarters, and you make some money again. What's unique about right now is that with the volatility in the market and with people taking their risk exposures down, you've just seen a lot of these strategies that are doing a lot better than they've historically done. And surprisingly, some of them are just hitting it out of the park. And I've just been spending a lot more of my time on event driven just because you have discrete events. They're usually a couple days to a month at most. The return profiles are just incredible. You're taking pretty low risk because you're doing this in a diversified way where you'll have 5 or 10 of these trades on at once. And they all kind of balance each other out. You never want to have one trade that actually moves the needle. It's more that at the end of the month you look at how your P&L looks and decide if it's been good or not. But along the way you don't ever want to show up and be down a couple percent or up a couple percent either. It means you're doing it wrong. But I've just been amazed at how well this has been working. And I know a lot of people they show up to work and they say I'm a value investor or I'm a growth investor. Or, I do gold. And I'm just saying that sometimes it's good to get out of your style box and look around because there's other things that are working very well. And, particularly me as a value investor, value is not working very well. So you have to be adaptable. And, I always tell people that the worst thing you could do ever is sit in your style box and complain it's not working.
Yeah. Okay. Perfect. All right. Thanks a lot, Kuppy, for taking the time and doing the update. Hopefully next time maybe we won't wait this long.
Sounds good. I'm happy anytime.
All right. Thanks.